Hey, what's going on everybody? Alex here. Welcome to another video. And in this video, I'm going to talk to you about how to qualify or how to buy more home. Now, this works for both sides, whether you're trying to buy a house now and you're having issues, or you are in the, exploration stage of buying a house and what this is going to kind of show you what we look for as a lender. Now, I am a licensed mortgage loan officer. I have a team of loan officers, and I also produce loans. Now, we do this every single day. Not only am I doing this with my clients, but I'm also sharing things on YouTube. So if you have not gone through any of our recent videos, go back, watch some of those, and don't forget to smash the like button. Turn that button blue. Now, we're going to come over here. And I want to talk to you guys what we look at as a mortgage lender, and when you are buying a house, what they look at to actually get you qualified to purchase a house. Now, I did a video on this recently. It's going to be linked down below. It's how we calculate your debt to income. Now, your debt to income ratio is actually the most important aspect of buying a home. And I mentioned this before because this is a qualification ratio. This ratio tells us exactly how much home we can afford, which I'm not going to talk to you about the ratio, but I'm here to give you tips on how to get this ratio lower to maximize your purchasing power. Like I said, this whole video is about how to buy more house. Now, whether you're in a position to buy more house, it's kind of really up to your situation, but I want to give you the tools. I want you to put the tools and the tool belt on to find more success with buying your house. So this ratio is very, very simple. What we do is we take your all of your monthly debt obligations. We're going to add it to the new mortgage payment that you're qualifying with. And what we're going to do is we're going to divide that by your gross monthly income. So all of your debts are going to go here. Now, the only thing that's going to go into this bucket are going to be debts are on your credit report. Your gym bill, your Netflix bill, your phone bill. We do not add any of that stuff. So I would not put that into your calculation. Now, if you are budgeting and creating a budget for your household, absolutely put that in your calculation, right? But in terms of just talking about buying more house, and for the sake of this video, don't put it in your calculation. We're going to add it to the new mortgage payment. And now what we're going to do, now this mortgage payment is your total payment out the door. That's going to include your taxes, your insurance, your homeowner's insurance, and when I said insurance, I'm talking about your mortgage insurance, your homeowner's insurance, HOAs if applicable, right? Everything, if there's subordinate financing, everything added into that payment. And so that's your total payment entirely. So what I would suggest you do is get this payment. If you're in the process of buying a house, if you're in Utah or Nevada and you would like us to look at your stuff, we would absolutely love to. But if you are in the process of looking for a house and you have a mortgage lender already, find out what your total payment is or your top end payment. Be as conservative as you need to be. Then what you're going to do is you're going to take your gross monthly income and you're going to put it into this bucket here. Now this income piece, right? This income piece is important because depending on how you get paid at your job, it really dictates how we qualify, right? Now, it doesn't always make sense, but just because you make it in terms of making money doesn't mean we can always use it. The lender's always going to look for what's stable and what's predictable. And so if your income is deemed not stable or predictable, which means it varies. So let's say you work part-time and your hours all over the place, your income is varying. Let's say you're a commission like myself, right? Your income varies. If you are getting overtime or bonus income, your income varies. And so whenever income varies, you have to take a 2-year average of that income. The reason why this is really important, because again, I'm trying to help you qualify for more, which is all about this percentage here. So I would work backwards. I would, number one, find out what your income is. Nail down your income. If you have a mortgage lender you're working with already, then have them give you what your income is or what they deem that's going to be good income. So get your income dialed in, because unless you're going to start making more money all of a sudden, this is probably not going to change quickly, right? Now, unless you got a new job promotion, that doesn't mean you're not going to be able to use it. It just means that it's just not likely, but if it is, then good for you. But take the income that you're making now, and then what you're going to do is you're going to take this payment that you are trying to buy on this house. So let's say this payment is $2K, okay? And let's say your income is $4K. And let's say your debts were 0, right? So if we take this calculation, 0 plus 2K is 2K. Divided by that, you're at 50%. 50% is too high. Now, not necessarily for all loans, but 50% is going to be too high. FHA loans, you can go up to 56. Conventional loans, you can go up to 50. So you're kind of right there at this bucket, right? You're kind of at the max in this scenario. Now, let's kind of talk about exactly how you can qualify for more. I kind of really wanted to set the table so you had a very good idea of what we look for to even get you qualified. The moment you learn how to play the game, you just got to learn how to play the game well. But you got to learn the rules first. Learn the rules and then learn how to play it. So the only way to get this ratio down, right? The only way to lower this ratio right here is to lower your debts, okay? Lower your mortgage payment or increase your income. That is the only way you're going to lower this ratio. So again, when you guys are calculating this yourself, you want to make sure that this ratio is going to be under 56 to 50%. You want to keep it under. So how can we get under that? That is the magic question. Like I said here, the number one way is to consolidate your debt. If you have low debt, this is going to be typically most people's problem. It's either here or they're just not making enough income. And that is why it's my philosophy that you can't save your way to buying more house. You can't save your way to financial independence. You have to learn how to make more money. This right here, if you learn how to make more money, your debts could be negligible because you're making so much income. Right now, it doesn't mean just because you're making it, you should go spend it. I'm not saying that. I'm just saying this ratio becomes a whole lot easier if you have a lot of income. Now, let's say you don't have a lot of income. Your next thing is you need to look at what debts are going out. So here's one way that we can do it. If you're married and there's two people there's two people in your household that are making income, you could move some of your consumer debt into that other person's loan or into their name and not use their income. Now, this all depends. There's a lot of scenarios that it depends, and you have to calculate it. Everybody's so different, but I believe in dividing and conquering. To divide and conquer, it's very valuable because, again, if you're in a non-communal state, then you don't have to take the other person's debts. So that is fantastic because if you have zero debts in your name and you have enough income to support the payment, or therefore you're under 50%, makes total sense. So second thing is if you have any credit card debt. Now, one of the benefits to credit card debt is the payments are typically low. And so in terms of this calculation, you could have a $5,000 credit card bill or payment, but your monthly payment could be $80, right? On the other hand, a $5,000 auto loan, your payment could be $150, so almost double than what the actual other payment is for a credit card debt. So that's one of the pros to having credit card debt. Now, there's not a pro to having credit card debt and carrying credit card debt. Just so we're clear, pay that bad boy off, guys. Pay it off. But what you can do, let's say you own a car, and let's say you have an auto loan that you've had before. You have the original loan on it. You bought it a couple years ago, and you never refinanced, nothing. You just let it ride. Your payment, let's say, is $300. Okay, I don't know. I'm going off the cuff here, guys. Now, what you can do, let's say you have a $5,000 credit card debt. So you have $5K in credit card debt. You have, I'm going to fix this. Okay, so you have $5K in credit card debt. You have a $300 auto payment, and you only owe $3K, let's just say. And let's say, and I'm trying to make this super easy to understand, but it's pretty simple. You don't always have to pay debt off, but if you know how to move it around, you could lower your overall monthly debt payments on your credit report. Even though you never actually pay anything off, you can maneuver money a little bit and therefore get your overall monthly payments or cash flow lower. And at the end of the day, that is going to help you guys buy more house. So what you're going to do is say you have a $300 auto loan payment, but you owe $3,000. You go to your bank and they say, or you go to Kelly Blue Book and they say it's worth $10K, right? Because again, you bought it, you've been paying it down, never touched your loan, but you only owe $3,000. Now $3,000, is not going to give you $300 payment, but it's important to know with installment loans, your payment does not adjust to your new balance. It sticks to that amortization schedule. That makes sense? So what we're going to do is one thing that we do all the time, and it's important to have a relationship with your credit union or your bank. And what we'll do is we'll say, okay, you have $5K of credit card debt. Well, this payment is $80 a month. Let's just say that we were saying before. Well, what we can do is we could take this car, which you have $3K. We're going to take $3K plus your $5K because we're going to take a cash out refinance on the car. We're going to pay off the $5,000. That's $8,000. Now's your new loan. Well, it's worth $10K. Now, one of the cool things is depending on your credit score is you could finance up to 100 to 120% of your auto loan. Now, sometimes more, sometimes less. It all depends on your finances and your credit union and their risk threshold and what rates you're going to qualify for. But theoretically, you're going to be able to now consolidate and lower your overall payment. Now, what I'm going to do is I'm going to pull up an auto loan calculator and we're going to actually see what the rough payment will be. So if we take $8,000, we take let's say a 5% interest rate over 60 months, your new payment is $151. So if we come back, your payment is $151 at a 60-month term. Now, the 60 months, some clients, well, I don't want a 60-month term. I spent all this time paying this car off. You don't have to keep it for 60 months, guys. Pay it down faster. Just because your overall payments are less, take the money that you're saving, debt snowball it in, and pay it down quicker. But we don't care about how long this is. All we care about is lowering this front ratio, right? So the best way to do that is we just took $380 between your car payment and your auto loan, your car payment and your credit card debt, and we turn it down to $151. That right there, guys, is how we are going to qualify for more house, and we never actually took money out of your own pocket. We just were able to shuffle money around, take advantage of loan terms, take advantage of an asset like a vehicle, take advantage of amortization schedules, take advantage of low rates. Like, we're taking advantage, guys. This right here is how to become financially savvy. So, now we know the name of the game, lower your debts, right? We know that. The other name of the game is increase your income. We know that, right? So if you guys want to qualify for more house, if you focus on those two areas, you're going to get typically as much home as you're going to want. Again, keep in mind 50% is your guys' target to be under. Now, it's ideal to be less than that, but I'm talking about strictly from a qualification range. So if you guys have any questions and found this valuable, again, please turn that button blue down below. Share this with some friends or family that are looking for a house and are maybe having just a little bit of an issue to getting just a little bit more. So if you guys have